If you plan on using a pot of invested money to pay your income in retirement, you're going to need to know the amount of money you can take from that pot so that it lasts as long as you need it to. This is what the 4% rule aims to tell you in a very broad way. In this video, we're going to examine where the rule comes from, how it can be useful, and its limitations. We'll show you what it really takes to make your retirement fund last for 30 years, and by the end of the video, why you might be able to get more income from your savings than you think. That said, let's get into it. Anyone funding their retirement from investments knows that the value of the pot will rise and fall with the markets, and that creates a problem. We know that over history, investments in the stock market have returned between 7 and 9% a year. That's true if you look at major markets like the US and the UK, going all the way back to 1900. At first glance, that seems plenty to supply the income you need. Just take that 7 to 9% that's generated from investments each year, and you won't even need to touch the capital beyond that. The problem is that as investors, we know we can't rely on that return. It is the historical average, but you might be investing in a period when returns are lower than that average. Just because something has happened in the past does not mean it will be repeated in the future. And whatever the average return you get in the long term, markets can fall in the short term. And that matters a lot when you're withdrawing money from your pot. Because if markets fall soon after you begin taking your income, you'll have to sell more assets to get the income you need, leaving fewer assets to grow again when markets recover. In other words, taking amounts equal to the historical return leaves a significant risk that your pot diminishes too quickly and you run out of money. The answer then is to take less, but how much less? Enter William Bengen, an American financial planner who, in 1994, set out to answer that question. Bengen looked at decades and decades of real market data. He used some very complicated maths, known as Monte Carlo simulations, to work out the outcomes in a huge number of possible market scenarios. What he concluded was that for a balanced portfolio of shares and bonds, withdrawals set at 4%, with those amounts then rising each year with inflation, would mean that a retirement fund would last for at least 30 years in the vast majority of scenarios. The 4% rule quickly became an established rule of thumb that investors could use when planning their retirement income. It was an easy to understand baseline that gave people something to build their plans around. But it's not a perfect answer to the question of how much income you can take from your retirement fund. In particular, it is likely to be too cautious in the majority of scenarios that most investors in retirement find themselves in. And that makes sense. Bengen was looking for a level that would provide a near guarantee of your money lasting. Over the decades of data that he looked at, the worst scenarios would have included deep stock market crashes and periods when inflation soared, meaning withdrawals had to rise along with it. All investors know that these things are possible, and over a retirement lasting 25 or 30 years, you better be sure that some of them will come along to threaten your income plans. But you'd have to be very unlucky indeed to experience the perfect storm of all of them. This chart helps show what I mean. It shows the value of a £100,000 fund of someone who retired in the year 2000 with their money invested in the UK stock market. You can see the value of the pot today after 4% withdrawals have been applied. Even all these years later, when presumably this person is well into their old age, the pot remains close to its starting value. Now, that's very reassuring for this person, but it probably means that they could have safely taken higher levels of income. By contrast, the other lines show the dangers of taking too much income. Withdrawals set at 6% mean their money will have already run out by now, while 8% withdrawals would have seen the fund run dry after just 14 years of their retirement. We can hopefully see then that the right amount to take from your retirement fund is specific to you and the particular market conditions at play through your retirement, and you don't get to know those in advance. It's safe to say, however, that 4% remains a highly cautious rule to apply to your retirement income. In point of fact, William Bengen has acknowledged this. He's returned to his calculations in recent years and now thinks someone retiring today could afford to take more, closer to 5% or even higher. Remember, none of this is personal advice. Applying the 4% rule or some other fixed withdrawal rate at the start of your retirement and then sticking to it come what may is pretty unlikely to get the most out of your retirement income. If things go badly, you could run out of money. But if they go well, you could be left with large sums at the end of your life that you didn't make use of. That might be part of the plan, but if it isn't, you will have suffered lower income in your retirement than you needed to. To optimize your income, you'll need to course correct along the way and stay flexible with your income plans. One way to do that is to ensure that you have a healthy reserve of cash to sit alongside your investments. If markets turn against you, you can use money from the cash reserve for a while to give your investments the chance to recover, so you don't have to sell them when prices are low. You might also invest in some assets that produce an income naturally. They could be dividend-paying shares or bonds. If markets fall, you can limit the income you take to just this natural income, again, protecting yourself from having to sell assets. And of course, if you're not confident to do all of this by yourself, professional advisors are there to put a plan together for you. They will look at all of your circumstances, like your other sources of income and savings. They'll help you understand your financial priorities, the areas that you have to spend money on, and those that you're actually happy to let go if you need to. If you found any of this useful, do subscribe to the channel to get more content like this as it is released. And give it a like or join the discussion in the comments below.